Okay. Okay, it's recording in progress. And ladies and gentlemen, good evening. And Jeanette, myself, and Arthur want to welcome you this evening to the Strategic Multifamily Investing with Dr. Jeanette and Sanjay. It's an educational webinar series. And why is it not moving? That's a good question. Okay, there you go. So in this is our attempt to come up with a webinar series for all of our investors, because we believe that an educated investor who has a better understanding of multifamily and understands its lingo will be in a better position to make a more educated investment in not only with us, but any syndication out there. And our effort is to bring out that particular element that every single person will have in their mind. It's like, should we be investing in multifamily, or how do we do this? And what kind of returns do they get? So that is our small effort from our end to educate our investors. Now, a disclaimer before we get started. This webinar is for educational purposes only and should not be considered as legal or accounting or investment advice. The information in this document does not represent an offer to sell or solicit of any offer to purchase an investment or security. Please consult with your own attorney, financial advisor, and CPA for legal matters, investments, and specific tax situations. Jeanette?
All right, welcome everyone. Thank you so much for joining us. This is very exciting for us. We got on a few minutes early, Arthur and Sanjay and I, and we're talking about how happy we were to be able to see everybody tonight and present this information and answer questions. It's really good. So I know a lot of you, some of you may not know me. I'm living in Seattle currently. I've been in full-time healthcare practice for 24 years. Actually, I keep saying 15 every year. As soon as it hit 15, I just kept saying 15 and 15, but it's actually been 24. And by way of introduction, I'd like to talk a little bit about change and what I've seen change in those 24 years that I've been in practice. So when I first got out of school 25 years ago, my husband and I, he went to school with me, we practiced together, and we got very excited to open an office. And I think we graduated on a Friday and we were ready to open on Monday after that. But everything was ready, we got the doors open. And the first person through the door was not someone that we would end up taking care of. It was the guy who sells Yellow Page ads. So that was the first person to show up. I think we did actually eventually get him under care, but he was the first person that showed up. So at that time, Yellow Page ads were the thing, and you had to have one. And we agonized over it because he had us convinced that if we bought the 1/8 page size, it would more or less be invisible, and people would skip right over it to the 1/4 page ad that the practice up the street had bought. So and all practices at that time had names with A in the beginning, right? So that you would alphabetically be first in the Yellow Pages. So that's what was important then. And it was a good thing that they sold us a contract, because it was shortly after that that everything about advertising changed, right? And the internet started to be there, and there were other ways of doing this. So I had to adapt to that. We all had to adapt to that. And I saw practices that struggled to adapt or couldn't adapt were hurt. So then everything went along okay for a couple of years. And the next thing that happened was Blue Cross Blue Shield, that was the main provider on the East Coast, decided suddenly that they didn't feel like paying for certain services anymore that they'd been paying for years. And they delivered that information to us in a large book that they dropped on our desks in January. And we all learned what would no longer be covered. So what I watched from that was practices and practitioners who couldn't adapt were damaged or their incomes went significantly down, and a lot of those practices ended up closing. In this case, it was such a dramatic change when Blue Cross pulled everything back in. So what I learned from that after those two major changes in how advertising worked and how insurance was or was not going to be dependable was that you needed to have some kind of backup plan, because change was and is going to happen. So change can be scary, but I think it's only scary if you're not prepared or you get caught and you feel vulnerable. And then change is scary. So I started looking into other streams of income, and real estate was one that I considered at that time. Once I had those other streams set up, I had more freedom, and that wasn't freedom to leave my job. I didn't intend to or want to leave the job, but it allowed me the freedom, for instance, to move and start a practice in another location because I had the resources to do that. And flash forward a bit now, in the last 3.5 years, you're all aware we've been dealing with a pandemic, which created major change and upheaval for everyone. I'm most familiar to what it did to healthcare offices, and I have seen a significant number of practitioners that I know just decide to close their practices altogether and go virtual and move completely online. I've also moved kind of halfway into telehealth as well as a result of what's happened during the pandemic. So the end of the day, the message was, be prepared for change since it's going to happen, and don't get caught off guard. And the way to do that is have streams of income that don't depend on your main job. And so I've been teaching seminars to healthcare providers for 20 years. And this is a small shift from teaching healthcare content to teaching now about another way that you can take care of yourself. So again, we're really happy to be here. I'm looking forward to hearing your questions, and I hope that everybody gets a lot out of the information that we have. Okay, I'm going to hand it back to you, Sanjay.
So yes, so I've been in corporate job, having a W-2 job for almost 20 years. And one thing that really changed my mind to go into, multifamily is because I tried out different things. Like in my mind, it was trying to figure out what are the things that I can really do. But the one thing that really made me think about I need to get into a business of my own was after, almost 15 to 16 years in managing multi-million-dollar corporate accounts, both in the United States and abroad. One of the things that really came was my son's accident. When he got into an accident, it really hurt me that I was not being able to be there with him. Or in fact, I was so busy with my career that I could not even see how quick he had already grown and he was ready for college. And I have a 12-year-old daughter now, and I really would like to see her grow and spend more time with her as well. So that was one of the main reasons. But to me, it was like, what are the things that really happens? As I was growing within a company, I was making much more money. So I said, hey, I need to start making some investments. So I started making certain investments in single family homes. And I started also making investments in multifamily as an LP, as a limited partner, and also in storage houses. And I started seeing that I was making more money from multifamily and these passive investments compared to that with the single family, where I was actually losing money in many cases. So I wanted to know more about it. And that's when our mentor had come down to Charlotte. And I went for their seminar. I tried to understand what it is. And then later on, I felt, yes, this is something for me. And I went to their boot camp. And later on, 3 days of boot camp was very good. But at the same time, I wanted to know more about it. So I signed up for their mentorship program. And I did that so I could learn everything very well. Once I did that, that is when I decided to, network and, make sure that we bring in the right kind of team on board, have the right kind of tax professionals, legal experts on our side. And that's pretty much how I started off with Blue Ring Investors in 2021. So what was our thought process when we first came out with? Dr. Deepa Bhatt is on the call right now. I have to give her the credit for actually me even starting off, focusing more on medical professionals. She hired me as her consultant, but at the same time, I got to learn a lot working closely with her. The challenge is that not only medical professionals, especially with her, I learned medical professional, but then I later figured out it is not only for medical professionals, but also busy professionals and high net worth individuals who might be having similar problems. So we decided that we help busy professionals build passive wealth by bringing together sophisticated and smart investors who, with our leadership, can leverage the group's combined greater financial power to invest in carefully chosen high-performing deals. Because we feel that healthcare professionals do so much for us. This is one way that we can give back to them. Now, coming down to the main things, right? Avoiding mistakes is a huge part of success. It's easier to tear something down than it is to build it up. That's a fact, right? So being wary of mistakes should be a significant part of any investment plan. I would definitely say that you'll for sure make more profit without mistakes, and that is what we are here for. We are here to educate you and make sure that you don't make any mistakes. But these are some of the mistakes that most of the investing mistakes that people do. First of all, not having a plan. I think it's important to know where you're going and how you want to get there, right? That's you need to have a target in mind. What is your time horizon? How much risk can you endure? Because when you're young, you can take higher risks. You can put it in, stocks, bonds, and all of the others, which are high risk. And knowing what you're trying to accomplish is also a key part of it, right? What are you saving this for? How long will it last? Another mistake a lot of people do is being emotional. Successful investors, they deal with facts and make appropriate decisions. Those that are excessively influenced by emotion tend to have a challenging time, whether it is stocks or bonds, or whether it is real estate, right? Oh, I love that building. It looks so good. I have to have it. Yeah, that's not a really good way of looking at it. That's why we sit down over here. We look at it. We do our underwriting in such a way where, for us, it is more about how do we make this number look better, and how does that really give our investors the best returns. So that is one of the things that we focus more on. Having unreasonable expectations, right? Over the last 90 or so years, the stock market has returned an average of like 10.7% per year. The best investor only consistently beat that mark by a couple of percent, right? While it's common to hear of investors making 40+% a year, that's merely a snapshot in that one time. But if you really look at in an average thing, it's usually anywhere between 7 to 10.7% is what you're looking at. So why are we here, right? We're here to help. That's the first thing. But as you get closer to your retirement, you might want to make some changes to your investment strategy, because as you get older and you're getting closer to retirement, you really want to have that safe, secure feeling. So, but it's funny that economics and all of the people out there, they cannot come up with one single magic number, right, for individuals to save and have a comfortable retirement. There are several factors to consider, but at the same time, a lot of people say that, okay, hey, before you actually retire, you must have a saving of 50 to 80% of your annual income to maintain your current lifestyle. Then some people will say, most experts will say, you should be save enough to be able to draw down about 4% of your total retirement portfolio each year, keeping a large enough balance to cover your remaining life expectancy. But honestly, who does all this kind of math? Do they really sit down? How many of us really sit down and go into these nitty-gritty details when there are so many things that are going on around us, the unknowns that are happening, where we have no idea of what a 401k might look like a year from now, or by the time we retire, because the market is always fluctuating. So considering passive income is an important thing. So I always encourage people that in addition to your retirement portfolio, remember to look for alternatives to fund your retirement. Annuities and passive income streams such as rental properties are additional ways to beef up your retirement income. So, most people that we speak to don't have to be wealthy as much as they want to have financial freedom, to live life on their own. Like, they don't want to create an empire. A lot of them really want to see that they retire comfortably and not worry about where their, money is going to come from, or whatever they have saved, is that sufficient or not? So this is why we encourage them to go into passive income. So the ultimate goal of your retirement portfolio is to ensure that you have the ability to fund a certain standard of living once you stop working. You can reduce your level of stress and apprehension as you retire, retirement draws near, and ensure that you reach your retirement goals with smart retirement plans and portfolio changes based on your individual needs. And that is what we want to do, help you understand more about passive investment, more about multifamily, and how we help our investors get to that standard where they don't have to worry about their retirement or future. Jeanette?
Okay, so you can see how important education is to us. We consider ourselves an education company, at least in part. And what a great job we have then, where we get to bring together teams of educated investors to purchase and then elevate a property for the benefit of everyone. The communities improve, we create jobs this way. We have this group of investors who's benefiting. So for everyone, it really works out well. And I think the elevation of the community is one piece that's forgotten sometimes as an end result of how real estate investing works. So if we look then, I already said educated is something we want. Let's look at the types of investments that the SEC strictly regulates and that we get to use. And these are called, if we shorten it, 506B and 506D. So you can see the full title there, Regulation D, Rule 506B or C, but usually you'll just hear 506B or C. So with a 506, and the main, let me back up, the main difference between them is how we advertise them or don't advertise them. So with a 506C, we are allowed to advertise that in multiple ways. We can put things on the internet. We can get the word out any way that we like, but with a 506C, we can only accept what are called accredited investors, and we'll look at that definition in a minute. With 506B, we can offer these only to people that we have a pre-existing relationship with. So we can talk to family and friends, which many of you on this call are, all of you are, and we are not allowed to market that broadly like we can with a 506C. Okay, you can go. So with the 506B offering, we need to verify an investor's word that they are accredited or a sophisticated investor. With sophisticated investors, we form the relationship. We have them fill out a questionnaire on the website. We do phone calls, and we get enough of a sense of who that person is and their history with investing or their financial background for us to know that they have the knowledge to make a smart investment and they're not going to get themselves into trouble. With a 506C offering, the SEC puts a little stronger onus on us to prove that that person does have accredited status, and that can be done by the person's attorney or a CPA, or there are online websites like verifyinvestor.com that can do that job for us. Sometimes it's possible for syndicators also to look at W-2s and bank statements and brokerage statements, but typically we let the person's attorney or CPA or one of these online groups do that work for us. Now, this is the definition of an accredited investor. before people have heard the terms accredited or sophisticated, they tend to think the sophisticated one sounds like the harder one to achieve, but it's this one. Accredited, this is a person who has an income of at least $200,000 a year, or if they're married, a combined income of $300,000 a year for the last 2 years, with the expectation that that will continue. Or they have $1 million of net worth excluding their personal residence. So that is the definition. And for a sophisticated investor, it's a little more, it's not a gray area. We know it when we see it, who it qualifies as a sophisticated investor, but this is someone who can buy stocks, bonds. They have enough knowledge that we're sure that they're not going to get themselves into trouble with an investment. They've got experience with financial and business matters that make them capable of evaluating a potential offer that they're going to be involved in. So investors are considered sophisticated if they possess sufficient funds to not extend themselves, their net worth, the financial sector experience. It's very important, especially to us, that non-accredited investors have a previous relationship with us before investing in a real estate deal. We need to get to know them. We enjoy that process. So for example, if you were to register with us at Blue Ring Investors, then we'd get to know you via our questionnaire on the portal and live calls. I go out and meet as many people as I can at real estate meetups and meetings and seminars. So our goal is to become very familiar with that person and what their goals are with regard to investing. So here are the goals for our class today. We want to cover 3 important terms that you need in order to analyze multifamily investment opportunities. Now, I've been on the phone recently with a lot of investors, and they've told me personally that they need to hear these terms a few times before they really sink in. They need to hear them and then apply them as they analyze different deals. And so it would be nice if we could maybe read these things once and understand them, but typically it takes a little bit of time to pick up this language and learn to use it. Once you do, though, that skill is what allows you to really be comfortable analyzing potential offers. So we'll cover some important terms that you need to do that. We'll look at principles of quick deal analysis, where you can easily say, I think this one's for me, I think maybe this one isn't. And then we'll look at how to get started and take it to the next level from there.
So learning the language of commercial real estate investing, right? So let's look at the 3 important terms in multifamily investing. And we chose this purely based on the conversations Jeanette and I have had with our investors and some of the questions they keep repeatedly ask us. So we just thought, okay, let's focus on these 3 main right now. Obviously, as we continue with our webinars, we'll be bringing in more terms and more lingo that, or the jargon, you may say, that investors or we in multifamily or syndication use. So one of those is like mostly asked questions is, what's cash on cash return? What do you mean by average annual return? And what does it mean like equity after the sale? Or sometimes people just say it's the back end return. So, so we'll take them one by one. So cash on cash return. So cash on cash return is something that you get from day one, or at least I would say, from the time we get started, 3 months or 4 months after we get started on this one. But it is something that it comes from the profit after everything has been paid. So, after your operating expenses, your mortgage payments, asset management fees, all these things are taken out, and whatever is left is something that we would then share with our investors. Now, this is just an example that I'm giving. Say, for example, you have invested about $100,000, and with our underwriting, we would have come up with a math where we'll say, hey, based on our investment on this particular property, where we are making all these heavy lifting or changes to this, upgrading the units and finding the new tenant base, trying to bring them in come up with a newer rent and all of those expenses when it goes away. Typically in the first year, you probably might not see a great return. But this is something like a typical return you could expect, that in the first year you might just get about 3%, 0.3%. The second year, because we made some of the refurbs and we have made it to a next level and made some improvements, it goes to 7 and then 9.8 and so on and so forth. So just to get an understanding of what cash on cash would really mean is that if you would have invested about $100,000 and within that, every year, whatever cash flow you would have got from the profits, if it comes up to like $34,000, you have made an average of 7% cash on cash. That's pretty much what it means in a nutshell. Now, what are our goals for a cash on cash? Now, this is, it all depends from, one opportunity to the other. It will be different, but just to give you a 30-foot, view, is that if we don't see an average of 7 to 10% cash on cash for our investors over the period of time, the property is held, we don't even venture into that because sometimes it's just not interesting for our investors at all. Now, what is average annual return? Now, this is the thing. Some people will tell you that, okay, hey, I got a return of X, 10% is something that someone has given us, and from day one. And then there are some who will be telling you that, okay, hey, it's a fund. I have no idea where this money is going. But when we give you the returns, we give it to you in two ways. One is from the actual cash flow that comes from our month-to-month activities. And then because we have made all these investments in upgrading the property and bringing in new, and reducing our costs and bringing in new tenants, all of these things will improve our net operating income. And because when the markets are very strong, when we sell the property, and after we have paid off all of the expenses and returned your money, now whatever is left is again shared with our investors. So what does that really mean is, let's say you invested about 100,000 and you made a total of 75,000 in cash flow, distribution and profits over 5 years, which means you saw that the cash flow in the previous example. If you take that and you add to whatever returns you're going to get after the sale, say if it is $75,000, then if you do the math, where you divide your investment of 100K, take the resulting 0.75 and divide that by 5 years, you have an annual average of about 15%. Now, what is our goal? At Blue Ring Investors, we look at property and we look at it as we want to get the best returns for our investors. So normally from a 30-foot point of view, we normally will not go into any opportunity that is going to be less than 17 to 21%, which means overall it comes down to like 95% to 105% of your investment at the time of the sale of the property. So this is pretty much what you're looking at with investing with in a syndication kind of an opportunity. Now, obviously, people say, what is the equity after the sale? It's the amount of money that is left after all the expenses are paid. Again, as I mentioned before, this amount is the one that gets split between the investors and the sponsor. Now, most of the time, there are two different types of investors that we see. Some people who really like, cash flow over equity, right? They want this to be something that is coming to them on a month-to-month basis, and that is something that they really appreciate. And then there are others who, just like how you have investors who take higher risks and are willing to take that higher, on the back end, they're not in a rush to get this cash flow. They don't want to make they don't make their living based on the cash flow. They wait till the last. So there are different kind of people. Some people might think that not having enough cash flow in the beginning can be scary. It is a risky thing. We may not want to invest in this. Then there are others who will say, hey, this is a strong market. It's in a great market. this looks good. We understand there is a lot of heavy lifting to be done. So we'll wait until the sale of the property. So this is pretty much how it looks like with the cash flow. What happens is when you have less rehabs required for the units, obviously, and you're able to raise your rents without doing too much of rehab, guess what? You have a better cash flow. But at the same time, if you have heavy lifting to do and you're doing some heavy rehabs, you got to make sure that, the tenant leaves the place and then you do the changes. That takes away some of your rental income during that phase, and which takes time for you to stabilize the market. But during that very same period, you would have also appreciated the value of that property, which during the sale, you get a very strong backend. So that's what we mean when we talk about, the risk and rewards kind of a thing. But majority of the time, we try to find a balance where we go into a property, which at least with blue ring investors, where you could have an average of at least 7 to 10% cash on cash, and about anywhere between 17 to 20%, ARR through the hold of the property. Jeanette?
So now you've seen those three really important terms and how you would want, you'll need to use those concepts with every investment that you look at. And then each one of those investments will kind of land on that sliding scale depending on the location and the time to do the rehab of the units and get them re-rented. So there'll always be kind of that sliding scale, but you can learn what those terms mean and kind of find where your sweet spot is on that. So we talked about investing for retirement. It definitely matters. And I also think that having passive money coming in now is a good thing too, to help you do things in your life now. Like I mentioned, it allowed me to move or have some freedom where I didn't have to be working all the time. I could actually take a break from the job I loved and intended to go back to and relocate, for instance. So there are a lot of reasons why people do investing, and getting really clear on that matters. And one example I can give of that is I've talked to investors who say, I really want to do this, but I just don't have the money. The funds aren't there. But as soon as they get clear on their why, it's amazing how fast the funds do actually show up. I think just because they're clear now on what they want to do and why they want to do it. So it increases momentum. Let's say that, to get to the end goal. So why do you want financial freedom and what are you going to do with it? And then it's also important to keep learning all the time and reach out to people who want to help and teach you, which we do. So we never feel any pressure or want to give the impression there's any pressure to go into any kind of investment. If you need to look at 50 of these before you feel comfortable doing one, we're fine with that. We want everybody to be happy. This is a team that we're pulling together over a period of years to all benefit from bringing up a property to its full potential. So you can also sign up on our website. We have a lot of free information there. You can receive our newsletters. You can download a copy of Sanjay's book, which is, I'm going to brag slightly about you, Sanjay, for a second. It's a very concise, I think 35 pages, where terms like the ones that you just saw are all together there in one place. And if you have a digital book, it's very easy to search for a term and bring it up. So his book is there. I also put 4 classes up there. I think it takes about 30 minutes to do them all. And we call it Investing 101 because it also covers some of these concepts about tax savings and the different terms that you need to know to evaluate investments. So all of those resources are there for you. We are a resource also, and we're happy to answer any questions, including now during this webinar, but at any time on the phone, or if you evaluate an opportunity with us. we're happy to make ourselves available. Thank you so much for being here. If you have to leave, we understand, but if you want to stay with us for a little bit and you have any questions, we are open to that.
Yep. Please feel free to unmute yourself and ask any question that you may have. We will do our best to answer you in best way possible.
Yeah, this is Jeff. I have a question. And first of all, though, Sanjay and Jen, thank you very much for a very informative presentation. That was very good.
Thank you.
You mentioned part of the investment is based on the sale of a property, right? That sort of that back end return that you were referring to.
Correct.
Broadly speaking, what triggers the sale of a property? Is that known at the beginning that this investment will have a 5-year period, or do you sort of go along and just assess the best time to sell based on the market conditions at that point in time?
We actually have a crystal ball that we'll look into. No, I'm just kidding. That's not what it is. What we really do is this. Yes, this is a part of our underwriting. So what we look at is, so as you look at your property when you're buying a single family home, right? Right. So you're buying a single family home, you have in mind, it has to be in a certain school district, it has to be in a certain locality, and it has to have these kind of features and things like that. So you go to that particular place and you decide that I want this 2-bedroom, 1 bath or 1.5 bath house. And say, for example, a neighboring house which has got a similar kind of size house, guess what? Say it got sold for 900,000. Now it has set a bar for the entire place, right? Mm-hmm. Now, if you want to buy something very similar, you have to look at it based on the inventory over there. You will probably end up paying at least 900,000 or more, because now you have more competition who will try to outbid you. Now, that comes a time when you decide that, hey, I really, really want this house. This is an emotional buy because this is everything that you dreamt for. This is what you exactly wanted and all of those. Now, when it comes down to us, that is not how we do business. For us, everything is numbers. So what do we look at? Say, for example, there is a 2-bedroom, 1 bath, a 60-unit apartment right here, and it gets sold for about, say, 2 million. If I see another one right next to it in that same neighborhood, and if it has got the same characteristics, we will still not be paying that much. We'll probably go for lesser. Why? Is because for us, it's not the entire building the way it is. It is more about what does the building bring us. In short, it is the net operating income. What does net operating income mean? Is you take your earnings, you take your expenses, you take that out, that's your net operating income. Now, every particular place will have what is called as a cap rate or capitalization rate, right? So what ends up happening is the higher the cap rate, lower your purchase price. So for example, if you were to, let me do one thing, I can actually share this screen with you because I think this example will be much easier to explain. So that way, there you go. So let me share my screen and boom. So say, for example, your net operating income of that particular, can everybody see my screen?
No.
No? Now?
It's loading.
Yes. Yep. Thank you.
Okay. So this is the net operating income. Say, for example, the property has a net operating income of 154,636, right? And if in that particular area, if the cap rate is 4, then the fair market value for that particular property would be considered as $3.8 million. Say, for example, the same property is in an area which has got a cap rate of 6, the same property will sell for $2.5 million. It all depends on where the cap rate is when you're buying that particular property. Now, what is our thought process when we buy the property? Our property is when we go after it, there are certain things that we go also. Number one, it has to be in an emerging market. It has to be in a B or C class area, and it has to be a B and C class property. Now, when we do this, one of the things that we're doing is we are upgrading it because it has some value adds to it. So we do the value adds and we bring it to the market rent. What does that mean in short would be is that, hey, we upgraded the property. Now we have made the, we have appreciated the property's value. And at the same time, we are increasing the rents for that tenant because the market demands it. Once we do that, guess what happens? Your net operating income goes up. At the same time, as the managers or as sponsors, it is our responsibility to make sure that we try to keep our expenses low and keep our incomes high and do whatever is necessary to make that good business plan. And that is where a good syndicator versus a bad one comes into play. As we go over the years, right? So we have, in the 5-year plan, we have raised our property, the net operating income over a period of time. Guess what happens? Say, for example, when we had purchased it at $154,000 in net operating income, and the cap rate was about 4 cap rate, we had purchased this similar property for 3.8 million. Now, if, say, for example, the market stays the same for 5 years and it's still going strong, and if it sells for like 4% cap rate, we will be selling the same property for 8.4 million. But now nobody knows where that is going to be, right? So in our thought process, what we are looking at is we want to hold the property for not for a very long time, anywhere between 3 to 5 years is what we look for most of the time. When we do that, what happens is our thought process is always that, okay, today we bought it at 4. What does it really mean if the market goes to 5 cap rate or 6 cap rate? Will we still be making money? Will our investors still be making money? That is the key, because our goal is to make you more money, right? And we try to see where we're going to stand in the worst case scenario. And we find that happy medium saying that, okay, we want to sell this property within this 5 years, and this is where we want it to be. And that is how we take that into consideration, that, okay, it might go up to 6, but if it does, at the same time, if it gets sold at 5 cap rate, you'll be at 6, so your profit margin goes up. But how do we look at those things? We look at, in our math, in our underwriting, that we want to, at least 2x your money, or get somewhere close to at least 100 or 105% rate of return is what we are expecting. And we do this math based on that, and we find that happy medium, and that's how we come to you with that. Does that make sense?
Yeah, yes, it does. Yes, it does. Thank you.
And just a follow-up, do you kind of have to leave it like in a position where whoever's going to buy it can still either add some more value or know that there's going to be growth? Because I would think that it would only be marketable if that was, otherwise they're just investing for cash flow.
Absolutely, good question. Now, again, depending on who's buying it, it can be the case that somebody just wants to, because it's a good cash flowing thing, I'm just going to invest this money in it and I'm just going to go through it, right? Now, then there will be syndicators like us. We look for properties that need some value add to it, and so that's one of the other things also that we really do, is that even though sometimes if the market is at like 5 cap rate or 4.5 cap rate, we'll sell it at, say, 6 cap rate, because now what ends up happening is the person who's buying it is getting it at a good price. So that is his reasoning for going after it. And we also sometimes don't upgrade all 100% of the units. Sometimes we leave a few so that we leave some meat on the bone for the next person to come in and take it. So it's always like, say, for example, what ends up happening is, so he gets some bump on that one. That's one part of it. The second part of it is what ends up happening is by then I would have held it for 5 years. He would have held it for 5 years. Guess what? In 10 years, it's been rented. It's time for the next person to come in and do some more renovation, bring it to the next level. So it's all about the same thing, rinse and repeat kind of a thing.
Okay.
I hope that
Interesting.
answers your question.
Yeah.
Mhm.
Any other questions? Dr. Dan?
You did such a good job, Sanjay. There's no.
Hey, Sanjay, how are you doing?
Hey, I'm doing great. Nice
Hi,
to
Dan.
see you.
Hi, it's good to see you too. So, just to summarize that cap rate thing, because I know I went through this with you once before a while back, the big picture without the fine details is that the value of the property may change based on this calculation of what's going on and so forth. But you're just looking up front at worst case scenario when you sell it versus best case scenario you sell it. And then you do the underwriting. You try to be more on the conservative side. So we hopefully will be making more than what we projected. And so but the idea and the whole game of it is the underwriting. So you have to like really get into like an honest like number to say, okay, this is what based on the projections of the next 5 years in the area and what's going on in the markets and all that kind of stuff. But I think you did say one other thing to me once before that I don't know if you mentioned before, is that the difference between the real estate, like if you own a home versus this type of real estate, is that it's not as much valued on the property of what's going on. It's more valued on the income that it brings in, right?
Absolutely.
So I remember you showed me a deep dive in that once where you were just talking about that, if you can really know the numbers, that what you project by how many renters you have and all that, that's what's really going to tell you more about what it's going to be worth when you sell it, right?
Absolutely, Dr. Dan. I think I did a fantastic job of spending that 10 o'clock in the night till 2 o'clock in the morning. That was a fantastic educational thing I did. So yes, you're absolutely correct about it. There are a couple of factors that definitely helps that we take into consideration when we do the underwriting. We look at the rent roll. We look at, how quick, when does the lease going to get over with so that we can start doing the remodeling? How long will it take us to do the remodeling? How much of, time, because every time you're taking a little bit longer, guess what? You're losing revenue. So those are the things we take into consideration. We also take into consideration what class of property it is and how much of an upgrade is truly needed. Like, do we just need to do the full electricals? Do we have to do the plumbing? Or do we just have to do some upgrades? So, and what would it cost us? So all of those things factor in. And obviously, the area. That is what what we look at is it in the path of progress? Because what is the city going to do to this particular area to make it better? So we take all of those things into consideration and come up with those numbers when we do that. So it's a lot of homework that we do before we start plugging in those numbers. And yes, that is one of the things that we will be talking in our next segment when we come up with our second webinar, which we have decided is going to be the 17th of next month, is that we will be talking about how to weed these things out. Like, what are the questions that you should be asking your syndicators when you're looking at those numbers? What does those numbers really mean? And how genuine are those numbers? And how realistic are they? And that is what we want to empower you with in our next segment. So that's, yes, Dr. Dan, we'll be deep diving into these kind of things as we move forward.
Thanks.
I just have one more question about the renovations. Like, do you risk if you upgrade it too much, do you risk out, what's the word I'm looking for? Like you losing all your renters because, I guess you could do some renovations like that you would only raise the rent, say 10%, but others could raise it like 40%, depending on how much you really renovate the building. And if the building's in a C-class area, but you renovate a lot to bring it up, like in that 25, 30, above percent, is the market still going to carry that? Or how do you determine that?
That's a very valid question, and it's a very important question, actually. There's no point in building a Taj Mahal when you don't need one of them, right? So that is another part of our due diligence. Like even before we start doing the underwriting, there are a couple of things that we do. We try to look at the comps. We try to see what the neighboring buildings within a reasonable 2 to 3 mile radius or 4 mile radius are actually renting for, and what is the condition of those? Like, is it like a newer property? Is it what kind of features that they have? Why is somebody paying more over there? So we do all of those, and then we decide whether we want to make this investment or we don't want to make investment at all. So that is one of the key things that we do, is look at it very, very closely, even before we start plugging in the numbers or even doing the upgrades. And we don't make the numbers work. We want to make sure that the numbers work for themselves, which means we put in realistically what we feel should be there and what is going to happen. And if the numbers don't add up, there's no point in us just trying to inflate the rental just to show it to you, because that is not going to happen in real. So that is again a very valid question, and that is one of the things that we want to share with you about how do we, what does our underwriters, what goes on in the underwriter's mind, and what's the kind of homework that we do before we even start writing, start working on the underwriting.
Sanjay, there's one more question in the chat box. The cost of building materials has gone way up. Have renovation costs been adjusted for this huge increase?
Absolutely, very good question. And that is one of the beauty about rental properties, right? It's a hedge against inflation. So that's always there. We hedge everything against that. So as prices go up, if everything goes up, you don't have control over the stock market, but we do have on this one. People need a place to stay. Right? So things go up, it's not only the cost of renovation is going up, but cost of everything is going up. Your gas prices are going up. So you're paying for those and you want a place to stay. Now, there have been instances where we actually didn't even have to do some of the renovations, and we were still able to actually increase the rents, and people just take it because that's what the market demands.
There's one more question just in the chat box. What is a return of capital? For instance, there was in year 2 of Georgia.
Okay, so I think this is something that Amy will have to get a one-on-one on this one, because we cannot discuss it on this platform because it's a 506B, but definitely we can have that conversation. And I'll explain it to you more, because one of the things that we have, if you looked at it, we have done, we are going to be doing a refinance on that one. So that's a total different thing that we can talk about. So yeah, how about we go ahead and schedule a call with you to discuss and dive in deeper into that one.
Sure, thanks, Sanjay.
Always a pleasure. As I said, we are very strictly SEC compliant, and we want to make sure that neither me, Jeanette, or Arthur look good in orange jumpsuit, and we have no plans of being in one.
So true.
Any other questions, guys?
They've been a half hour over, so.
I think we got them all. Well,
Thank you.
everyone, thank you so much.
Yes, thank you.